Tesla shares, they're up over 11% in pre-market trading. The move higher in shares offering investors some relief. The stocks had a rough start to the year, down over 41% year to date, heading into the release here, but moving higher, as we were mentioning, off of this report. To break down the street's reaction, Colin Rusch, who is the Oppenheimer managing director here. And Colin, I'm so glad we have you, because for the street hearing now that you have a new affordable vehicle that's going to be fast-tracked or moved up in the roadmap here, is that what the street wants to hear at a time where you've already seen price cuts be initiated or some of the different pricing strategy play out that has a larger impact on the margins that we also have to consider for Tesla?
I mean, this has been a growth stock that's stopped growing. And so what the company really needs is an incremental growth driver. The CyberTruck has been incredibly disappointing as an incremental vehicle. And so they're trying to refresh the product suite. And part of the issue here is that they've saturated demand on the Model 3 and the Model Y. They've been huge successes, but the next leg of the story has to be this lower cost vehicle. Now, we have a lot of questions around the specifics here. I mean, they gave us a rough time frame on when they would start production, but the actual integration of a new platform with the existing platform is a relatively complicated challenge, and we'll see how the actual cost structure plays out as we begin to see some of the production. And I think it'll probably be early next year rather than later this year.
Yeah, Colin, talk to us just about that realistic timeline, and if we don't see a cheaper vehicle by the end of the year, is that something that you think is going to hit the stock here in later quarters?
Well, this is something we're talking about with investors. This has gone from a stock that had, real numbers, and we went from being a story stock for a lot of years to having real results that were driving the stock higher. And we saw that move a number of years ago to returning back to the story stock, element of the stock. And it's interesting to have the story be one, a low cost vehicle that's pretty nebulous at this point, as well as the robotaxi. Obviously the promise of, Tesla being the leader in AI for the physical world is, I think, very compelling, and one that we think is real over time. How that translates into financials is really a big question mark right now. And with the Model 2 or this low cost vehicle, we don't know where the price point is going to be, what the cost structure is going to be. And so we think there's maybe another one or two numbers cuts before we start to see things inflect higher.
So, Colin, then it sounds like the worst for Tesla isn't behind it yet. Is that right?
From an execution perspective, I think they're going into a very challenging period. They've made a bet that the learning cycles on their neural net will accelerate here between now and August, and that they'll continue to improve the functionality on the FSD. And we think that's not a certainty. There's a lot of debugging that has to happen and a lot of work to get that moving in the right direction at the pace that they're talking about. We think they're on the right path, but there's a lot of hard work. And at the same time, merging two vehicle platforms is not a trivial endeavor, and something that we think probably has been put on the drawing board for them and on the plans just here in the last 4 to 6 weeks.
Colin, the company talking about and the chief financial officer talking about on the call the ability to reduce costs without sacrificing on quality due to the amazing efforts of the team, yada, yada, yada. But sacrificing on quality, that's continued to come up in conversation either via recalls or even via some of the initial reviews of the Cybertruck when people were talking about the paint on the side or the rusting that was taking place. So are consumers getting the bang for the buck that they've come to expect or anticipate when they're getting into a Tesla? And how does that, in one way or the other, impact their decision to purchase with Tesla as a repeat customer in the future versus going to some of the other automobile manufacturers who are themselves eyeing some EV ambitions?
I think it's a good question. So there's a couple of things that I'd say about that. First, we've gone past the point of early adopters who are going to be pretty forgiving around some of the finish and fit issues that Tesla's run into. At the same time, the company's done an incredible job on cost reduction. They continue to walk those costs lower by designing out elements at the system level. They're enjoying some tailwinds on the battery side right now. And so the balance of quality and cost reduction, I think they're doing a reasonable job on that. That said, as you get into a broader pool of consumers, the tolerance for some of the difficulties that folks have around delays on repairs some of the cost of those repairs, some of the details on the car, I think diminishes. And so the company has to do both here. They have to improve quality and they have to continue to walk costs lower. And it's a pretty high bar, especially if you're going to start looking at a new platform on a very accelerated time frame.
Even as we're watching shares move higher today, for some investors that are still a bit perplexed after this earnings report and trying to figure out what's the clear buy signal, what is that clear buy signal that they could potentially be looking for if they're looking to add Tesla to the portfolio, even if they're going into what you mentioned as a period of operational challenges?
For us, we're still on the sidelines here. We think this rally this morning is largely a cover rally and some short positions. We think that's going to start to fade as we get through the balance of the trading, today and over the next couple of weeks. And I don't think if you've got a short thesis on Tesla and margin and price erosion, you walked away from last night's quarter with a whole lot of concern, other than the margins were just a bit better than you expected. And so there's still intense price competition. There's still an awful lot of work for these guys to do to bring this new model forward and continue to drive cost out. And at the same time, the company's taking on some incremental technology risk in the commercialization front. And I think they're pioneering this AI in the physical world market, starting with FSD, but it's a lot of work and it's a lot of management focus to get that together. And so I think what you want to look for if you're going to buy the stock is point when numbers aren't going lower. We lowered numbers this morning. We think there's another 1 or 2 cuts left to go. And the point that you start seeing numbers begin to go higher on both the revenue and the margin perspective, then I think you can start buying the stock. But I don't think we're there yet. Yeah,
margin's better than feared, as you mentioned, but the margins on the auto side still declined from 18.9% to 18.5%, excluding the CyberTruck impact as well. Colin, thanks so much for taking the time here today, breaking down all things TSLA with us. Colin Rusch, who is the Oppenheimer Managing Director. Appreciate it.